In this video, we're going to be talking about finances. We're going to be talking about how to invest risk-free and what is the overall best investment. I'm going to be answering a question I got from the Bulldog Mindset membership Facebook group. I'm John from BulldogMindset.com. On this channel, I teach you how to become financially independent, to build the physique you want, to get the girls that you want, and to go from the victim mindset to what I call the Bulldog Mindset. If that sounds good to you, if that's what you want to do, click that subscribe button. If it sounds like a load of shit to you, then get out of here. It's not for you. How do I get more than 2% from cash in a money market without taking on a lot of risk? The stock market is long overdue for a correction, so high yield stocks look risky but have very high yields in the 5 to 6% range. Housing in my city only returns 4% on rentals due to high taxes, but that's 100% more than money market. When we're talking about a 4% return, follow along with me here because it's going to be a little bit complicated. A 4% return is what we call a cap rate or capitalization rate. If you took $100,000 of money and you invested into this rental property, you could expect a 4% return in terms of cash flow on your investment. You could compare that directly to a money market, where if you put $100,000 in the money market and you get a 2% return, you would get $2,000 a year. But that is not how real estate investment works. Let's just say you have $100,000. You're either going to invest it into the money market at 2% or some stocks at, let's say, 5 or 6%, or you're going to invest into real estate. If we just take that, you're going to get 4%, but that's not all that you get with the real estate.
The point here is to make money, right?
In addition to that, you're going to gain appreciation. It means that the property value itself goes up. You can't really count on appreciation, but historically we know that the average is between 3 and 5%. It depends on the area slightly, but you're at least going to get, let's say, a 3% return on top of the 4%. So you're already at 7%. On top of that, you're also going to get depreciation. Let's say that you have a $100,000 property and $80,000 of it is structure and $20,000 is land. On the $80,000 that structure, you can depreciate it over 27 and a half years for residential real estate, which means that you're going to take that $80,000, you're going to divide it by 27.5, okay, and you're going to deduct that amount as a loss from your taxes every year. You make $4,000 in rent, okay? You take $3,000 away from that, and so you only show a profit of $1,000. You only pay taxes on $1,000 of that rent. You're making, let's say, the 4% on the capitalization rate, which is the cash flow. You're making, let's say, 3%. These are conservative estimates on depreciation, which makes it 7%. And then you're getting a tax discount on the depreciation of the property. That's not typically how you invest in real estate, though. What you would probably do is put a down payment and borrow some money. You put $20,000 down. The first thing it's going to do is it's going to wipe out most of your cash flow. Okay, instead of making $4,000 a year, okay, you're going to be paying debt service. You're going to be paying for the mortgage on that property, which is going to probably wipe out that $4,000 a year to let's say zero. Okay, let's say that we're forfeiting the immediate cash flow on that property. Okay, probably you'll have some kind of cash flow. Maybe you'll have $1,000 a year, but let's just, to be extremely conservative, say you forfeit that. What we're going to do now is we're going to have a 5x lever on appreciation. You have only put down 20% of the property, okay, of the value of the property, but you've borrowed 80% from the bank. If the property appreciates 3% in totality, what's your return? That's 3 times 5. 15%. You're going to make 15% on appreciation if it appreciates 3% per year. Now remember I said 3 to 5%. If it appreciates 5% per year, you're going to make 25% on your money. Why is this? We could look at the math here. $100,000 property. If it appreciates 3%, it's worth $103,000. You invested $20,000. That was your down payment. You borrowed $80,000 from the bank. So if you make $3,000 off of your $20,000 investment, what percentage is that? What is your return? That's not where it stops. You still get the depreciation, okay? The same depreciation, and we could value that at $3,000 of a loss. So now you're showing a loss that's going to carry through to your regular income on your taxes. So you're going to pay less taxes. Now what is your overall return? Well, you got $3,000 that you made from depreciation, let's say, off of your $20,000 investment, plus another perhaps $1,000. So that's $4,000 off of your So now your percentage return is around 20%, but that's not where it stops. Okay, if you've leveraged the real estate, then you're also going to have a principal pay down, because when you're paying the mortgage on the property, you're also going to be paying the principal pay down. The principal pay down is going to depend on what the interest rate is. So now you're talking about even more money that your basic return on that real estate leverage could be 20, 25, maybe even 30%. Even if these numbers are slightly off, they're still way, way better than any other investment that you could possibly do by far. I repeat this over and over again. I've done a lot of videos on this channel. A lot of you just don't get this. What I'd encourage you to do is to just make a spreadsheet and do your own math to check all these things and to check everything that I'm saying. You have a capitalization rate. You have the cap rate on the property. That's the cash flow that you return from it. That's where most people stop, is they say that real estate yields, let's say, a 4% return. You don't have to invest where you live also. I want to look for cap rates that are in the 7 to 10% range. But then you have the appreciation. And if you've leveraged it, which you should, you have a leverage appreciation, which is the multiplier. Even if you only put 50% down in a property, right? So $100,000 property, you put $50,000 down, okay, you would still have a 2x leverage, okay? That would still mean that whatever the appreciation that you got would be doubled, okay, because you're making that money on the bank's money as well. When you add all of those up, even with very, very conservative estimates, you end up at least at 15%. Okay, but most likely or more like 20% and even up to 30% or more on a real estate investment. So when you compare this, okay, to money market, when you compare this to stocks, even dividend yielding stocks, all right, it just doesn't make sense to do any other investment than real estate. Real estate is just such a ridiculously profitable investment that I cannot recommend anything else. People all the time try to compare it to the index fund S&P 500, a low load index fund. All right, and it just doesn't even make sense. We haven't even talked about the tax benefits of when you actually try to exit your position, which in real estate you can do a tax deferment, so you can do a 1031 exchange, which you can perpetually defer the taxes, and in fact when you die and you pass on the property, the tax basis actually gets reset. Any way that you run the numbers trying to compare any other investment to real estate wins by a huge margin. It's not even a close comparison. If you haven't already, take the Bulldog quiz. You'll get an offer to join the membership community. It's an exclusive community. Is when you're around people that have the Bulldog mindset, that are successful, it inspires you as well. So go check it out. Click that subscribe button if you haven't already, and I will talk to you next time. Take care.